Okay, good morning, everyone. My name is Peter Legge, tax partner here with Grant Thornton in Belfast. You're all very welcome along to this, our spring budget webinar, focusing on Wednesday's announcements by the Chancellor of the Exchequer, Rishi Sunak. It's easy to forget, given the countless announcements that he's had to make over the course of the last 12 months due to the pandemic, that this was only the second time the Chancellor got his opportunity to present a budget to Parliament. The first, of course, coming on the back of 3 weeks in the job, and just before the country going into its first lockdown. Now, set against the context of lockdown 3, £280 billion worth of government support having been spent, and facing the biggest budget deficit in peacetime history, the threat of tax increases loomed large. However, on stepping up to the podium on Wednesday, the Chancellor sought to try and alleviate those fears as quickly as he could, at least for now. He structured and framed his budget around 3 key themes. 1, protecting jobs and livelihoods. 2, strengthening the public finances. And 3, leading and business investment-led recovery. Despite many of the announcements having been trailed in advance, there were still some surprises, some welcome and some not so welcome, and we'll hear more about those shortly. Attention now also turns to the 23rd of March, Tax Day, the date on which the Treasury will publish a number of consultations which could see a reform to capital gains tax and environmental taxes, together with an insight into the government's 10-year and longer-term tax strategy. So the purpose of our webinar this morning is to outline some of the announcements, the key announcements from Wednesday's budget, to consider the impact that those may have on you and your business, and to suggest steps that you may wish to take as a result. So to that end, I'm delighted to be joined by our resident experts this morning. First up is Andrew Webb, our Chief Economist, who will provide an overview of the current economic climate and share his thoughts on the government's economic strategy. Andrew will be followed by Lorraine Nelson, who will provide an overview of the various government COVID supports that exist. Then Mark Bradley and Alan Gourley will provide an update and indicate how the budget impacts on corporates and individuals respectively. And then last but not least, Lee Squires will provide an update in terms of the impact to indirect taxes, and also give us some insight into the investment being made within HMRC to tackle anti-avoidance. So let's kick off. I'll hand over now to Andrew. Many thanks.
Good morning, everybody. I'm very pleased to be here this morning. As Peter said, I'm here to give a little bit of an overview of the economic situation, and I suppose lay out a little bit of the context as to where the economy is. Very aware that I'm the warm-up act for the tax specialists this morning, so I'll not hold you too long before we get into the detail of the various initiatives that have been introduced in this budget. So we'll get straight in, and I just want to talk a little bit, I suppose, this morning really about how we're in a global context, which seems to be a little bit more settled than maybe previously. Give it an indication of some of the key economic indicators that we're tracking, and then talk a little bit more specifically about the budget and particularly the public finances and what that might mean. So as we look at the global context, and this is a chart we use often and really use this to track where we see the global picture, and we do get a sense from this index that there is a more of an air of relative calm maybe coming into the global socio-economic political space. Maybe that's just a direct result of lockdowns and not being able, people haven't been able to move as freely and go about their business. But there has also been a little bit of a salving in the global context with the election of President Biden and what that might mean then in terms of the global relations. So we do think the broader context is one where it seems to be a little bit more calm. And that's playing into the global economy, and we expect to see that come through in slightly less uncertainty. When we start to then think about the local lens and the key indicators that we're tracking, we just have those I suppose some of those key indicators and key movers in the last year. We've started really tracking, obviously, where the labour market has been going, very, very volatile at the minute, but has been heavily buffeted from the worst of the pandemic by the various supports that have been introduced in the Chancellor's announcements and the support that the executive have been able to put in place. Obviously, there's been elements that have had some people fall through the gaps, unfortunately, and there has been some significant labour market impact. But our view would be that it could have been a lot worse. Some of that, the other key indicators that we're tracking at the minute, obviously GVA growth, which is starting to look a little bit hopeful in terms of a V-shaped recovery or something in that sort of regard. Maybe not perhaps bouncing back as rapidly or as much as we were pre-pandemic, but certainly a strong recovery. And we've seen evidence of how the economy can move up through the gears when lockdowns lift. We see quite a lot of pent-up demand. Now, there's lots of different vagaries in the middle of all this and lots of different nuances to be worked through. The rise of internet sales, for example, there is a trend that probably accelerated by a decade. And while we have seen some move back to bricks and mortar retail as things reopen, we think that's a trend that needs to be carefully monitored, and what that means then for town centres and city centres around the country is something to be worked through. So just a little bit of a snapshot of where we are locally and how we expect some of those key trends that we're tracking to move over the next number of months. I suppose the one that lots of people are interested in is house price growth there, which was on the slide, which is just showing that obviously with the various initiatives coming through on stamp duty and the extension of that mitigation, that has released quite a buoyant house market currently, and we expect that to continue for a while, but obviously to taper off as those supports move away. So if we just get in now to some of the key elements of the budget, my focus will really be on the public finances, and I think the line that struck me was from the Chancellor was how they're taking a view that the recovery begins today. On reflection, after all the trails and the hype, it was a budget that it felt like a budget to me that was trying to move past COVID and almost ignore that it had ever happened. It was, let's deal with this crisis, let's move on. And I got a sense that the public finances have been taken out, whatever it takes, I suppose, was the key theme from the Chancellor, and that coronavirus support will continue until a point in time. And then it was a very much steering the speech between doing whatever it takes and then moving the economy forward, strengthening public finances, and then moving into an investment-led recovery. I didn't get any strong sense of changing how the economy functions or looking at how to maybe make the economy more resilient or move towards protecting or avoiding or mitigating another pandemic or another shock. But certainly we got a sense of, let's keep the support going firmly now and let's move on from this at pace, try to repair the public finances, and then move into infrastructure investment and an investment-led recovery. So it'd be interesting from an economy perspective to see over the next 6 months just what that means in terms of where the focus is. We expect it to be on, I suppose, big infrastructure projects and a withdrawal of supports, because the public finances are in a particularly difficult situation now. And if we just move on to look at some of those key elements of where the OBR are projecting the economy or the public finances to be, and just this slide shows just the sheer scale of support, and it has been. I know governments can be criticised, and rightly often, for their responses to crises and their policy choices. But I think the various initiatives that were introduced, and certainly furlough, were innovative and timely. But this just shows the true cost of that coming through. We're touching now, in terms of the total bill for COVID, we're just shy of 350 billion since this time last year, since the last budget. So, it's a scale that's been unprecedented since certainly wartime. We can see as well just that split between supports for business, households and public services, and the support for public services really having ramped up in the last number of iterations of the graph there, and certainly business supports and household supports maintaining at a level. It's just as we move through then into implementing vaccinations and getting through that, the public services have the funding going there has ramped up dramatically. What that means then for where we're heading in the economy, and just on the next slide, we see the various iterations of what I don't envy any forecaster at the minute. It really does feel like a bit of a guessing game for them. Having been one, I know it can be a difficult task in good times, trying to set the course of an economy with so many moving parts. And we see that just through the OBR iterations that there have been really since this time last year, when the forecasts were very different than where they are now. And actually they're different in a more positive way. The expectation now is that the recovery will be stronger and that unemployment will be lower than previously thought. And the hope is that the vaccine rollout is going to drive forward with quite a strong bounce back. So the prospects for recovery are improving, and that's very encouraging. I would, I suppose, flag that note of caution that was also flagged in the budget speech, which is the OBR are now suggesting that there is some permanent scarring to the economy. So it will be, in their estimations, 3% smaller in 2025 than it would have otherwise been had we not come through this pandemic. So the longer the pandemic goes on, the greater the risk of that permanent scarring. And again, that's something that we need to track through and see how that impacts on the broader economy. From a local context, we would expect a similar trend here. If we can follow the successful rollout of the vaccine, then we expect a lot of pent-up demand to flow through and release economic activity that would probably mirror that sort of central trend for the rest of the UK. So if we just move on just to finally have a look at the public finances and what that has meant for where we are with borrowing. So we're, no surprise, the media are tracking this and tracking this day and daily, that the public borrowing is at a post-war high. And that's various initiatives have been introduced, obviously, in this budget to try and move us beyond the current supports and move us into situations where there are revenue raising and a little bit of reduction in some spending areas. So we're looking at a context over the next number of years where the public finances will move into what the Chancellor would refer to as repair mode, and to try and get that borrowing rate down. The various initiatives that he introduced to start moving towards that, I'll now hand over to my colleague Lorraine, and the rest of the speakers will get into a little bit more of the detail on just some of the specifics around how we move forward in that context. Thank you.
Thanks, Andrew. And I just noticed there's a few questions coming through already, and so it's just, we're going to probably cover quite a lot of detail now here from the tax side of things. So look, if you have any questions, feel free to either raise your hand or pop them in the Q&A box, and then we'll try and answer as many as we can at the end of the session. I'm just going to quickly run through a bit of a high-level overview of the COVID supports that were extended as part of the budget on Wednesday. So firstly, I just want to look through what has happened for any of your employees. So I suppose, as was leaked probably then on late Tuesday night, it was all over the press then on Wednesday morning. So the sort of the furlough scheme, which is the coronavirus job retention scheme, as it officially is known, is extended now until the 30th of September. So it's probably just going to continue as it was. So it's really, the government will pay up to 80% of your employees' wages for any of the hours that aren't worked. So that flexible part of the furlough scheme is still remaining. Employers will still need to pay the employer's NIC and also any pension contributions. That will remain in place until end of June, and then in July we'll revert back to the way it was last summer, where 10% contributions will need to be required to the by the employers to sort of top it up to that 80%, and then that will increase then to the 20% contributions then for August and September. And just point to note is it's now a monthly claim, and you then need to make a claim within that 14-day window after the end of the month. So it's probably just making sure that you do have those claims in on time, because it is a bit tighter now to get those claims and get that money back in. In addition to that, he's also extended the statutory sick pay. So this is for any SME. So it really means if you're an employer with less than 250 employees, you'll be able to reclaim 2 weeks sick pay. So that will also cover people who are off because of COVID, or maybe if they've had to self-isolate or are required to shield or things like that in relation to COVID. And then finally, there's been quite a lot of questions and queries around sort of home office expenses. So I suppose a lot of people are now working from home, and the Chancellor has also extended that sort of pay as you earn in Class 1 and NIC exemption in relation to any employer reimbursed home office expenses. So it has to be relevant home office equipment. So for the likes of maybe laptops, desks, maybe accessories, headphones, telephones, things like that. So it means that there's that exemption still in place until the end of April next year. So that will also include this tax year as well. Then on to self-employed. So it's in line, sort of similar to the furlough scheme. The self-employed income support scheme as well was also extended. So really that's, as you know, that's in sort of grant form. So there's 2 more grants. There's a 4th and then a 5th grant. So the 4th grant, it will become available in April to claim for it in April. And it will be based on average monthly earnings, and it will be for a 3-month block to cover February, March and April of this year. It's also been extended to include people who've maybe missed out in the first 3 grants, who maybe only became self-employed during the 19-20 tax year and maybe wouldn't have completed tax returns. So it's now going to extend to more people. The 5th grant, I suppose in line with the way the furlough scheme is going, has got a few limits on it. So really it will cover May to September. Again, it will be based on 3 months earnings. But if your turnover has not decreased by 30% or more, there will be a restriction. So you'll not get that 80%. You will be restricted to just 30% of the grant that you would have been getting, and that's then capped at the 2,850. That claim, the claim should open then sort of mid to late July this year for those grants. And just a high level point on just on the next few, just a few other extensions, and I know Lee will cover these in a bit more detail under the indirect tax section. So I suppose the stamp duty land tax holiday has been extended. So that 500,000 threshold will apply up until the end of June. And then we have a tapered reversion back to the normal rate again in October. So it will drop to 250 until the end of September. And then back to 125 from October onwards. Also in relation to that sort of hospitality and tourism reduced VAT rate, from that down to 5%, it will again continue on to the 30th of September, and again will drop down then from October to next March at 12.5%, and then return back to the 20% rate from April 2022 onwards. And then just finally on funding, there was a new scheme announced. So there's a new recovery loan scheme. So it will launch from the 6th of April and run right through to the end of this year. Again, quite similar to the last few funding, government-backed funding, is that there's going to be an 80% government-backed guarantee. So the finance that will be available can be as little as 1,000 right up to 10 million. So we can look at those as term loans, overdrafts, and then looking at the sort of asset and invoice financing with the various limits there. And then there's a few obviously eligibility criteria. So you have to be impacted by the coronavirus and make sure that it is a viable business as well. And then I suppose just a point to note out the sort of the previous funding schemes are the likes of the CBILS that large CBILS and then the bounce back loans, they will all close on the 31st of March this year. So it's if you are thinking of increasing those or having a look at those, it would be worthwhile doing that before the end of the month. What I'm going to do now is just going to pass across to Mark Bradley, who will go through the corporate tax budget announcements.
Thanks, Marianne. Good morning, everyone. I think what I'd like to do in terms of the corporation tax made the headlines with this budget, because there has been a number of changes, both beneficial to some businesses, but obviously there has been a large increase in the corporation tax rate. So firstly, I'm just going to cover off the corporation tax rate. I suppose the Chancellor's hands were slightly tied in terms of raising revenue due to the triple lock. So in terms of doing this, it appears one of the main things has been to raise corporation tax rate from 19% to 25% from the 1st of April 2023. Now, he has said that this is still the most competitive in the G7. However, it's still probably a 30% increase for most businesses in their corporation tax rate. There is still a small profits rate, which is for taxable profits up to 50,000. The tax rate remains at 19%. However, with profits between 50 and 250, there will be a taper relief up to that 25% rate. So I think it's roughly about 10 years since marginal rate tax has been brought in, and there is a number of complexities just around working that out in terms of when you're looking at your tax compliance. I think it's not as generous as it was nearly 10 years ago. The limits were 1.5 million before you paid the main rate of corporation tax. It's now down to 250, and also that those limits are reduced by the number of associated companies. So what we'll probably find is that the majority of businesses, whilst the Chancellor said is that many will stay outside of the 25% rate, I think looking at our own client base, the majority of businesses will actually fall within that 25% rate. I think what this does, whilst being most competitive in the G7, and you need to look by the recent media coverage, our neighbours in the south have a corporation tax rate of 12.5%. So I know that there will be some debate in time to come around whether or not the Northern Ireland corporation tax rate, which is enacted, will come out. So just maybe turn on to maybe some of the reliefs that have been made available by the Chancellor. So again, this is a welcome change. I know that there's been a number of businesses that have lobbied for this. So ordinarily, you can carry back trading losses or losses for 12 months against prior year profits due to the impact of COVID, and a number of businesses will obviously be in a loss-making position. What has happened now is that those losses have been temporarily extended from 1st of April 20 to the 31st of March 2022. What that allows to happen is that this is only against trading losses. So those losses can now have the flexibility of going, I suppose, later year first, up to a maximum of 2 million to create a corporation tax-free payment. What must be known is that there's a group level limit. There's some complexities around groups. However, there's also a possibility to carry back at the minimum of 200,000, so before actually the returns are completed. And what it is sort of said in the draft legislation, if after the accounting year end, it is, there's no uncertainty that there's at least £200,000 to carry back, that can be done in an interim return. So just let me just show an example here of what that looks like. So under the old rules, you'll see here is that in 21 and 22, a business has made a loss, trading company maybe due to some the COVID restrictions. However, up until lockdown, have been making healthy profits. So under the old rules, only £1 million when in FY 21 could be carried back to FY 20, with the remaining losses carried forward for future profits. Under the new rules, there's a full relief for the FY 21 losses, but there's also a loss carry back of the 4 million from 2022. Now, it can get carried back for 3 years. So taking out 21, it can carry back against the balance of 20, which of another 500,000, and then the full profits in 19 of the 2 million. Unfortunately, FY18, because it's sort of 4 years from 22, can't be utilised against. So that brings forward losses of 1.5 million. Now, what that does for business, I think that provides some planning whether or not losses are carried back against the historic rate of 19%, but have to be looked at in the context of future rate taxable profits being at 25%. And so having a look at projections to see whether or not it is more beneficial to get cash in hand now or to carry forward against future taxable profits at that higher tax rate. So I'm just going to talk about another relief that has come in. I think it's probably the biggest headline, which has been the super deduction, as it's been called. So the super deduction as a headline, looks fantastic. The current position is that there's an 18% writing down allowance for plant and machinery, or for qualifying plant and machinery. This, which has been allowed for a 130% deduction on main pool capital allowances for plant and machinery, which are incurred between 1st of April 21 and 31st of March 23. So that also includes, it doesn't include, sorry, if you've already entered the agreement before budget day to acquire assets. Now, there is a bit of a health warning with these, and I suppose the devil's always in the detail. It does apply to general plant and machinery. However, it does exclude specific assets such as cars, leased assets, or long life assets. So those long life assets are usually big ticket items where a lot of spend will be incurred. Things like in the renewable industry as well, wind turbines, while certain elements may qualify, larger scale projects may not fall within this 130% super deduction. There's also a connected party anti-avoidance, which prevents transferring assets intergroup to avail of the 130% deduction. And ultimately, there's a bit of a sting in the tail in respect of a future disposal of the asset. So I'll probably illustrate it shortly. However, what that means is that if you acquire an asset now for £1 million, claim the 130% deduction, subsequently sell that asset in the future, there is actually a 1.3, depending on the proceeds received, there is a 1.3 piece, three add back, which can actually result in tax payable at a higher tax rate, i.e. the 25% in the future. There's also, what I think is probably better, is there's a special rate temporary first year allowance of 50%, again the 31st of March 23. So that's for assets like air conditioning, mechanical and electrical works, lifts, etc., which ordinarily would only qualify for 6%, reducing balance rate. However, we can now claim a first year allowance of 50%. And also the annual investment allowance has just been confirmed that it will remain at 1 million until 31st of December 21. So just to run through an example now in the next slide, we can see here that you have a manufacturing business in March 22 acquires machinery and special rate items. So under the old rules, they could claim more than likely the annual investment allowance and the special rate. The special rate, they were balanced at 6%, and the machinery at 18%, which gives about 1.4 million of capital allowances. So under the new rules, we'll actually still claim the annual investment allowance. You will claim the first year allowance as well, and also on the machinery, then you can claim the 130% super deduction. So you can see the difference there, 3.9 tax deduction in the year, which ultimately could create a loss to be carried back to get a tax reclaim. So there's a bit of planning involved in that. One of the issues, I think, from a tracking position is that these assets will need to be tracked because of a future disposal. So there is a wee bit of complexity in terms of ensuring that when you're planning your capital spend over the next year or two, how does that fit into the capital allowances claim, and how does that impact your overall tax position? Lastly, I'd just like to cover off something on the research and development tax relief. This was really to enact legislation that to cap cash repayments for SMEs from 1st of April 2021. This was really to combat sort of fraudulent claims. However, legitimate businesses may still be impacted. So as an example there, if you've got a startup business and they've maybe, say, 3 or 4 staff, however, most of their R&D costs are subcontracted out. When you go to do the R&D tax relief claim, as you can see from the example there, under the old regime, sort of pre-cap, the tax surrender for would be about 280,000. However, based on our scenario where you've got 4 employees and the lion's share of the costs have been subcontracted out, there's actually a cap on 170,000. So a business has just lost out on a genuine business on about £112,000 cash repayment to reinvest back into the business. I suppose lastly then, there's also been a consultation issued regarding the effectiveness of the R&D regime. There's evidence also suggesting that the revenue are reviewing the validity of claims in a lot more detail. And I know it's something that we are seeing a lot more of now. So I think there may be further scrutiny in terms of R&D claims in the future. What I'd like to do now is pass over to Alan to discuss some of the private client tax updates. Thank you.
Morning, everyone, and thanks, Mark, for the handover. The budget for employees and private clients was actually very modest. We were expecting maybe some announcements, but in reality, there was very little announced. So if we just go on and see what I'll be covering. So I'm going to look at what the rates and allowances are for next tax year and ahead. There's some important stuff in that. Mark's already talked about the increase in the main corporation tax rate. That actually feeds through in terms of taxation of dividends. And it's now starting to change, the advice around which business structure to use for your activities. And then lastly, I just want to touch on the IR35 changes that come in from 1st of April. So if we look at those rates and allowances that were announced in the budget, so what the Chancellor has said is personal allowance, basic rate band threshold and higher rate threshold will all change with indexation on 6th of April. And then they'll remain at those levels until 25-26. So he signaled very clearly where rates and bands are going for income tax. And it might seem like a quite innocuous thing to do, but if you look at the budget book that he published, keeping those rates the same until 25-26 actually raises nearly £9 billion. Now, when you think that the corporation tax increase, which is a 31% increase from 19% to 25%, raises 17 billion, you can see that actually, these income tax measures are big revenue raisers for him, and they've had a fair bit of press coverage over the last couple of days. He's announced also that the additional rate threshold, so the rate at which the threshold at which you start paying 45% income tax, is going to remain unchanged at 150. So that's the main rates and allowances for income tax. If we move on to some of the other things he announced, and again, it's quite interesting to have a slide that really says nothing, but he announced specifically that quite a number of the rates and allowances will remain unchanged until 25-26. So the capital gains tax annual exemption, the ISA contribution limit, the inheritance tax nil rate band, and the residence nil rate band for inheritance tax, all those are going to remain unchanged for the next 5 years. And again, that raises about £1 billion. So quite innocuous announcements, but there's actually quite a lot of tax attracted by that. If we move on just to the next slide, just on pensions, I suppose coming into this budget, the big things that we were looking for from a private client point of view were announcements on capital gains tax and also on pensions income tax relief. And pensions income tax relief is a perennial budget matter. And, I think the Chancellor really struggles to make dramatic changes there because it affects the industry and affects so many schemes and insurance companies and defined benefit schemes and the civil service and the NHS. So I think his hands are tied. So again, it's a slide that shows you nothing changes for the next 5 years. Now, he did specifically mention the pensions lifetime allowance won't change. The other ones, he didn't say anything. but there's been no increases announced. And I think, as Peter said earlier, we've got this tax consultation day on the 23rd of March. There might be something announced about how he's going to change the taxation of pensions, but it'll be a consultation, it'll be a signalling, it'll be a process rather than an event. Just on to the next slide. So as I said, the increase in the corporation tax main rate to 25%, when it comes in, it will make dividends less attractive for higher rate and for additional rate taxpayers. So that is going to mean more clients will take their money out of the company by way of salary or bonus, which can also be eligible for R&D tax credits. So you can actually create a better overall tax outcome at the moment. That's going to be much more compelling from 1st of April 2023. I've just got a wee table there that shows, for every £100 taken out, how much can the owner or director actually retain. Now, you can see that for a dividend, once these the corporation tax rate goes up to 25%, a higher rate taxpayer gets to keep £50.63. Additional taxpayer gets to keep £46.43. Now, if you look then at the salary or bonus column, if they were to take that £100 gross and including employer's NIC out of the company by way of salary or bonus, they would be marginally better off. Now, that's the first time that calculation has moved that way that I can remember. So for the first time ever, I think, for higher rate and additional rate taxpayers, salaries or bonuses are more tax efficient. And I think that's been quite deliberate. And I wonder whether that was the motivation behind going up to 25%, because you remember that the speculation was he would go up to 20% and then announce a gradual increase to 23%. But no, he's left it year two, but he's going straight to 25%. And I think this sort of salary dividend piece is probably in his mind. I think the Chancellor wants more people onto payroll, more people declaring their income through real-time information on the payroll monthly. It gets better data for HMRC. You'll be aware that they have this problem about the excluded in COVID. So company directors who have taken their money out of the company by way of dividend really don't get any COVID support. And what Rishi Sunak has said is, we don't have the data about, who receives dividends and where they're from. And the reality is, most people who receive dividends, it's an investment income over and above their other income. So to actually provide support for people that receive dividends would be a waste of government money. So I think he's been quite deliberate here to erode the benefit of taking dividends and get more people onto salary pay as you earn. I put in the last column there, and if we think about, right, how do we run a business? For many years now, a company's been much more tax efficient. Again, that is now eroded. So if you run your business as a sole trade or a partnership, or as I've put here as an LLP is transparent for tax purposes, so you're taxed on the profits of the business. You'll see there that the tax outcome is much better for higher rate or additional rate taxpayers. And that's something that we might see more businesses get constituted as partnerships, as LLPs going forward. So, I think that increase in corporation tax does have a big impact on what people are doing in terms of how they structure the businesses and how they take their remuneration. I think also, for family investment companies who maybe who have built up wealth in a company, that maybe owns properties, maybe has a portfolio, maybe has bonds receiving interest. The corporation tax of 19% has been very attractive for wealthy families. Again, with increasing it to 25%, I think the Chancellor is sort of deliberately hitting wealth captured and held in companies. So it's a big corporate tax change, but it does have implications for individuals. Next slide, please. This is my last slide. So, I think I just wanted to highlight the changes to off-payroll workers coming in on 6th of April 2021. So these are the people that provide their services through their own personal company. Some of the high profile cases are around television presenters. So Eamon Holmes provided his services to ITV through a company, and HMRC challenged that to say, no, you're an employee and therefore we should be collecting national insurance and pay as you earn. From 6th of April, there's now an onus on medium or large companies to assess individuals that they hire or contract with who provide their services through their own limited company or other intermediary. And the onus is going to fall on the payer or the hirer to assess whether they should be an employee or whether they are a valid contractor. And if they should be an employee, then they need to deduct pay as you earn from any payments to them. So this is a massive change. It came in the public sector in 2017, and Revenue announced that they'd extended to the private sector on 6th of April 2020. That change was delayed because of the pandemic. We had hoped and we had lobbied for it to be extended further, but government have been adamant on this. And again, I think this is about getting more people onto payroll, getting that data, getting them captured in that real-time information net, so that Revenue know exactly what's going on, and every payment is registered for tax purposes. So these rules are coming in very, very shortly. And I think, three takeaway points. If you're a large, medium-sized company, you'll need to have a process in place to identify who might be relevant. Who are you contracting with? We see it quite often with IT. So a number of our clients, most of their staff are employees, and then, how do you run your IT department? Oh, we'll use this contractor, but he comes in most days. He has an email address, a company email address, he's got a laptop. And I think it's people like that there needs to be that assessment to go, right, could they be caught by these rules? I think you need to identify. You also need to do an assessment. There's the HMRC CESS tool, which is a check employment status tool, assessed, and that's available online. Grant Thornton have a tool which is similar. We argue it's better, and it also creates all the documentation you need and keeps an audit trail. So that assessment needs to be done. Is this person an employee or are they a valid contractor? The company has to make that assessment and communicate the outcome. And if the outcome is their employee, then the payer has to make sure pay as you earn is applied to all of the payments. So this is a major change. We'd hope to get it deferred, but it comes in on 6th of April 2021, and it's something that can't be ignored. HMRC will follow up on this. It's a key area of target for them, and as I say, their objective is to get more and more people into pay as you earn. Okay, that's me finished. I'm going to hand over to our indirect tax expert, Lee Squires.
Thank you, Alan, and good morning, everyone. So I'm going to talk about the indirect tax changes in the budget this morning. Next slide, please. So Lorraine has mentioned the extension of the 5% reduced rate for the hospitality and tourism sector. So I won't go through that again. So what's interesting is that not only has the reduced rate been extended, but there's also now a new 12.5% reduced rate that applies for 6 months. So we're incrementally going back to the standard rate. Those change in rates may seem relatively straightforward, but they do raise a number of technical issues in terms of the transition between the different rates, because often bookings and payments are made in different periods to the period in which the actual accommodation, for example, is received. So if there was a booking now or in the last couple of weeks for accommodation over the summer, so it is important to make sure we get the VAT treatment right there and work out what the correct tax point is, which could otherwise lead to an over or under accounting for VAT. And in some cases, refunds may be due if VAT has been accounted for at the higher rate. There are also some other complexities around voucher schemes where vouchers are issued and they can be used at different times, or where there are mixed supplies, including the accommodation and food and beverages, which are subject to the reduced rate, and also other services that are subject to the standard rate. So particularly around room hire, for example, with hospitality or wedding packages have caused particular issues. There's going to be a new penalty regime that replaces the current default surcharge regime with effect from the 1st of April 2022. So that will apply where VAT returns are submitted late or tax is paid late. And that will be based on a points-based system where the penalties are meant to be more proportionate to the amount of tax owed. So hopefully that will be some good news for taxpayers. And that applies from the 1st of April 2022. It will also apply for income tax purposes subsequently as well. And the VAT registration threshold has been frozen at £85,000 until the 31st of March 2024. Next slide, please. I thought it would be a good idea just to recap on some of the other changes that are coming into force this year. Firstly, we have the VAT deferral new payment scheme, which applies where a taxpayer deferred the VAT last year under the COVID support. You were allowed to defer your VAT payments falling due in Q2 last year, and those were due then by the 31st of March this year originally. You can now pay those in 11 monthly instalments over the course of 2021 to early 2022. So that's a bit of a cash flow smoothing for businesses. The other changes came in 4 days ago. On the 1st of March, we have a new domestic reverse charge on building and construction services. So where that applies, it is the supplier won't charge VAT, and instead it's the customer that accounts for VAT. So that particularly applies to arrangements between contractors and subcontractors in the construction industry. From the 1st of April, the making tax digital requirements will be extended to include a digital links requirement. So not only do you have to submit your VAT return digitally, you now have to have an integrated digital journey between your accounting records and the software used to prepare and submit your VAT returns. So that may be particularly challenging for some businesses with legacy accounting systems. And then for the 1st of July in Northern Ireland, because Northern Ireland remains aligned to EU VAT rules, we will have to apply the new EU VAT rules for the business to consumer supply of goods. So the current distance selling thresholds will be abolished and replaced by a new one-stop shop under which you account for any VAT on supplies to consumers in other member states to HMRC, but at the VAT rate applicable in the other member state. So Northern Irish businesses that are particularly e-commerce businesses that provide supplies of goods to consumers in other EU countries, including the Republic of Ireland, will have to take into account those rules. And then finally, from the 1st of April 2022, a new plastic packaging tax will be introduced in the UK, and that will apply to the import or manufacture of packaging of plastic packaging with less than 30% recycled content. Next slide, please. On stamp duty land tax, Lorraine has already mentioned the extension to the nil rate band. Again, that's sort of tapering down gradually rather than disappearing immediately. So it will not revert to the standard 125,000 threshold until the 1st of October this year. As announced in last year's budget, the surcharge for non-residents on the purchase of UK residential property will apply from the 1st of April 2021, and that will be an additional 2% over the current rates that apply. And bear in mind that there's a special definition there of residents that's a little bit different to the normal definition of tax residents, and that applies to both non-UK resident companies and non-UK resident individuals. Next slide, please. On duties, the good news is duties were frozen on wine, spirits, beer, and also fuel. The government hasn't made any real changes to the customs or tariffs regimes following Brexit. I suspect Brexit was conspicuous in its absence from the budget. I think probably the feeling is that businesses are dealing with enough changes and uncertainty rather than having to get to grips with new changes. There are a couple of exceptions to that. One is that free ports will be introduced in Great Britain, and Freeport is effectively a special economic area which normally benefits from some kind of duty and VAT suspension and other tax benefits. In the budget, there was reference to enhanced capital allowances for businesses operating in a Freeport area, and also stamp duty land tax reliefs. Now, initially, these will be introduced in Great Britain, but the budget says that regulations for Northern Ireland will follow in due course. I think the challenge for Northern Ireland is that those free ports will have to be compatible with EU rules. So there may be extra complexities there, and they may not be as generous as the GB implementation, but we will need to wait and see. Finally, there was a special measure on the import of steel into Northern Ireland. Currently, some traders bringing non-EU originating steel from GB or from the rest of the world into Northern Ireland have faced a 25% EU safeguard duty. And that's because the EU decided at the end of last year that Northern Ireland cannot benefit from EU tariff rate quotas. So this has operated unfairly to Northern Irish businesses who can't make use of the UK or the EU quotas. So that what this provision will say is that steel originating outside the EU and the UK, which is imported into Northern Ireland, may now benefit from UK quotas or an equivalent tariff treatment, provided there is an open EU tariff rate quota, and that will be retrospective to the 1st of January this year. So that should help businesses who are bringing steel into Northern Ireland that is subject to one of those safeguarding measures. Next slide, please. And finally, I just wanted to touch on HMRC's disputes and investigations activity. The budget disclosed a significant investment in HMRC to increase tax revenues by targeting non-compliance and discouraging avoidance schemes. There was also some legislation to strengthen promoters of schemes. But what we didn't see, unlike last budgets, was a slew of new anti-avoidance provisions. So it seems that HMRC are now taking the view that they have the weapons in their arsenal on the statute book to deal with these schemes, but what's needed is investment in enforcing them. And what we're expecting to see is an increase in HMRC investigations and compliance activity. And we are already seeing that reflected in our client base. Grant Thornton do offer a tax investigations insurance product, which insures you against professional fees incurred in dealing with HMRC inquiries and investigations. So if you don't have something in place, it's well worth considering that, because if HMRC do decide to do a deep inquiry into your business, that can be very time consuming and expensive. I'll now hand over back to Peter to run through the Q&A part of the session.
Okay, many thanks, guys. Okay, we've just got a few minutes left just to pick up some questions that have been submitted. Maybe it's just if I can go to Andrew first of all, just a general question, Andrew, from someone in the audience there. Just the question is, did the Chancellor miss an opportunity to point to more direct initiatives to change things, particularly in relation to perhaps the green economy?
Yes, I would say yes, simply, and I'll expand on that. I suppose I hinted at it in my comment at the start, where I felt that it was maybe a budget that didn't maybe grasp just the significant or the scale of change in the economy that has been brought by the pandemic. You know, when we look across how we reacted and how things panned out, you know, we see there were big challenges in social care, there were big educational divides and big digital divides, the digital sales issue and, you know, business rates and bricks and mortar retail. So there were lots of big challenges, and I didn't see too much in addressing those. And I didn't see we saw some tipping of the hat to environmental issues, but I think there could have been initiatives there. And I know car scrappage has been one that has been maybe hoped for in that sector over the last year or so, and you know, there's a logic in trying to shift people towards more electric vehicles. So I think that could have been an opportunity to do that and to light a bit more demand under that sector, which has really struggled in the last year. So I suppose, you know, across a whole range of issues, yeah, I think there were opportunities to look at how the society and the economy has been impacted in the last year and start to really hone in on how to address some of those bigger issues. But I think that was an opportunity that he didn't take here, but maybe we'll revisit in future budgets.
I think it may be worth noting that I suppose the budget is not necessarily the single sort of standalone event this year. You know, we've already referred to the tax day on the 23rd of March, so we may hear more then, Andrew. Yeah.
Possibly so. Yeah, I hadn't appreciated there was a tax day until this morning, so that's another thing for tax guys to get excited about.
Tax guys getting excited. You know, 2 big events this year. Okay, thanks, Andrew. Question in from Graham Lapsley. It's Danske Bank's private banking team. It's a question for Alan. Alan, a lot of Graham's clients are in their mid-50s now and are looking at their pensions very closely. Do you think there would be a situation in the short term where there's a change to tax-free lump sum coming out of pensions?
I think, as I said, you know, pensions is always talked about in a budget. I think, you know, there's issues around, will the tax relief remain at your margin rate of tax, or will it be a flat rate of 20, 25, 30%? Will he do something with the lifetime allowance? Will he scrap the tax-free lump sum? These are perennial issues. I think we can't rule out some changes to the tax-free lump sum. He could either abolish it. I think that's unlikely. He could cap it, you know, which might be something he would do. You know, it'd be very easy for him to cap it at the lifetime allowance, you know, so anybody that has a higher pension pot can only take 25% of whatever the lifetime allowance is. Our advice in general is if clients can access their tax-free lump sum, we would often recommend that they do that so that they can take the benefit of it, because you just don't know what a chancellor might do. They've already increased the age at which you can get it, so it's 55 for a lot of folks now, but that changes to 57 soon. So, you know, I think our advice remains, if you can access it, you're probably better taking it so that you can enjoy, you know, that fantastic tax advantage.
Okay, thanks, Alan. Question in for Mark, just in relation to the super deduction. The question is just really just seeking clarification whether those qualifying assets to go to the capital allowance pool. And I suppose linked with that, I suppose a further question is there a potential sting in the tail on the super deduction whenever the asset is sold?
Yeah, thanks, Peter. Yeah, I would say that the capital allowances for the super deduction, it is still going to probably fall within the Capital Allowances Act, so we'll have to go into a pool. Now, I think similar to the short life asset pool, which is a separate pool, when you're doing the computation, that'll be a super deduction pool, as it were, whereby you have to, I suppose, trace or track these assets through the lifetime. The reason being, as you just mentioned there, around the future disposal value. So ordinarily, when you dispose of assets in the general pool, it's just an amount of proceeds goes into that, and it reduces your pool going forward. However, with the super deduction, because you've taken a deduction of 130%, if you were to receive proceeds of 100, you would actually have to add back really a 130 pounds. So I think there will be complexities around just how those assets are tracked in terms of when they're acquired, what relief is claimed on them, because you don't necessarily have to claim 130% on the full asset, and then also what the proceeds are in the future. So as you mentioned there, Peter, you would get relief now at 19%. However, when you go to sell that, you will actually be paying tax on the proceeds at 25%. So that's where I think there is a bit of planning to actually go through your capital spend over the next couple of years and see how that plans out from a modelling perspective.
Okay, thanks, Mark. Question in from Paul Prenter, just really seeking confirmation just as to when they're in relation to the free ports announced. Lee, you mentioned some of the free ports have been announced in GB. Do we have any insight as yet as to when there's any of those to be announced for Northern Ireland?
No, they said that legislation on Northern Ireland will be forthcoming, but they haven't said when. So in terms of the business rates relief, that isn't something that was mentioned specifically in the budget, but it may well be that business rates relief is one of those areas where they could provide a benefit. The ones that have been mentioned are the enhanced capital allowances and the SDLT relief, as I mentioned.
Okay, thanks. And maybe just a final question before we wrap things up for Alan. Alan, I suppose there's a lot that was announced on Wednesday by the Chancellor, but I suppose it's important just to identify things that he stayed particularly silent on, and you'd already referred to that in terms of the capital gains tax rate. And we have tax day coming up on the 23rd of March, and on which some of the consultations will be published. And can you give, I suppose, the listeners some insight into what some of the recommendations have been to date, particularly around the potential reform of capital gains tax? What can we expect?
Yeah, Peter, I mean, I think this is one area where there's advantages to being older, because as many people be aware, Office of Tax Simplification did a report on reforming capital gains tax. And really, a lot of what they're saying takes us back to the CGT regime we had in the 90s, before Gordon Brown came in power. And, you know, it's a regime that's been tinkered with continuously since then, you know, with taper relief and the constant changes to that, then entrepreneurs relief, then, you know, with hoiking the rates way up and then slashing them quickly, you know, so it's been a lot of changes to it. But what the OTS were recommending really was four things. One, there should be closer alignment between capital gains tax rates and income tax rates, and to introduce some sort of form of rebasing. They're saying rebase assets back to 2000 and allow relief for inflation. And that really does take us back to the 90s. The other thing they said was reduce the annual exempt amount dramatically, because a lot of very wealthy people just trigger that each year to get a bit of tax-free gain to rebase their portfolio. So they're saying reduce that from 12,300 to maybe say £2,000. Another proposal is to remove the capital gains tax-free uplift on death. So if you inherit an asset, you inherit it at its market value, and there's no capital gains tax charge on its uplift. It might be in the IHT regime or it might not, but the OTS said we should consider abolishing that CGT-free uplift and allow broader gift relief so that people can gift assets without triggering capital gains tax, so that there's fewer assets that are held to death to get that rebasing. And lastly was around business assets. So you might be aware that entrepreneurs relief is now business asset disposal relief. They said they should replace that with some sort of form of retirement relief. So again, that's just exactly the regime that was back in the 90s. And it seems, you know, in a number of areas, that's the way we're headed, because certainly of corporation tax and the marginal rate, you know, those calculations were done, were around in the 90s as well. So that's what was proposed on capital gains tax by the Office of Tax Simplification. I think let's wait and see what March 23rd. Let's see, the excitement builds to 23rd March for tax day.
Can't wait, Alan. Looking forward to it. Already.
Absolutely, yeah.
Okay, guys, just very conscious of our time. It's just gone 25 to 10 there. So we'll just really draw proceedings to an end. If anybody on listening in does have any other questions, all our contact details are on the screen in front of you there. So do please feel free to reach out to anybody in the team. And I suppose all that remains is for me to thank all the speakers this morning and to thank you for your time. Have a good day.
Okay. Bye.
Bye-bye.
Thank you.